If markets stopped printing prices for 10 years, would you still sleep well? Graham wrote rules for that.
Welcome to Capital Allocation Lab.com, audio-first lessons that turn classic investing ideas into decisions for owners.
Today, intelligent investing foundations. In 15 minutes. Graham's definition, the investing versus speculation test, and 2 pillars, margin of safety and Mr. Market.
Those pillars are really key. They're what separate the sound sleeper from the constant worrier when it comes to owning things.
Definitely. We're aiming to give you the shortcut, sort of the bedrock of value investing here.
Educational only, no advice.
Chapters below, let's begin.
Okay, so Graham's definition. What's really fascinating, I think, is that he wasn't defining success by, how much money you made. He defined the act itself.
Right. What did he say exactly? It was something like...
An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative.
Yeah, that sounds simple, but there's a lot packed in there.
Oh, absolutely.
You've got 3 distinct steps, really. First, thorough analysis. So no winging it.
No gut feelings alone.
Then safety of principal.
Yeah.
You have to protect your initial capital. That's paramount.
Job number 1.
And third, a satisfactory return. Not necessarily the highest possible return, just adequate. Good enough.
And that immediately sets up his test, right? Investing versus speculating.
Exactly. If you skip any of those steps, the deep analysis, the focus on safety, or just aiming for satisfactory,
then you're speculating. And look, he wasn't judging. He wasn't saying speculating is bad, just
be clear what you're doing. Know the risks you're actually taking.
Precisely. It's a clarification tool for you.
So if you buy a stock just because it's zooming up and, everyone on Twitter is talking about it,
where's the thorough analysis in that?
It's not there. So by Graham's definition, that's speculation, plain and simple.
Okay, so that brings us to the 2 big pillars supporting this whole structure. The first one, maybe the most powerful idea for defending capital, is margin of safety.
Right. Let's unpack that a bit. Margin of safety. It's not just don't put all your eggs in one basket, is it?
No, it's more specific. It's about the price you pay. Graham insisted you buy something for substantially less than what you calculate its real underlying value to be.
That gap is the margin.
Exactly. Think about like building a bridge. If it needs to hold 10 tons.
The engineer doesn't design it for exactly 10 tons.
Of course not. They build in a safety margin, maybe it can hold 15 or 20 tons. That buffer is your margin of safety in investing, the difference between price and value.
It's your protection against being wrong. Because even the best analysis can miss something.
Or just, bad luck happens. The economy turns. It's the best shock absorber you have. It lets you sleep well.
Which is crucial for dealing with the second pillar, Mr. Market. This is where Graham gets really metaphorical.
And so insightful.
Yeah, the Mr. Market story is brilliant.
Yeah.
He asks you to imagine owning part of a business with this partner, Mr. Market.
And this partner is, let's just say, emotionally volatile. Totally bipolar.
Every day he shows up. Every single day. And he offers to either buy you out or sell you his share.
And the prices he quotes are often completely nuts. They're based on his mood, not the business reality.
One day he's euphoric, asking way too much. The next, he's miserable, practically giving his shares away.
And the key insight from Graham is, Mr. Market works for you. You don't work for him.
His mood doesn't tell you anything about the value of the business, only about his current feelings.
Right. You ignore him most days, but sometimes his crazy prices are useful.
If he's depressed and offering a ridiculously low price for his share, and you've done your homework and know the value is higher,
you buy. It's an opportunity he's serving up.
And if he's ecstatic and offering a sky-high price for your share,
you might consider selling. You use his moods to your advantage.
So going back to that opening question, if prices disappeared for 10 years,
you'd be fine. Because you bought with a margin of safety based on the business's real value, not Mr. Market's daily quote. His silence wouldn't change your reality.
So wrapping this up for you, the listener,
right.
What's the takeaway? Intelligent investing, for Graham, wasn't about being a genius. It's about discipline.
It's an operational framework. Do the analysis, demand safety, aim for satisfactory, and treat the market's noise as, well, mostly just noise, sometimes opportunity.
Use Mr. Market. Don't be used by him.
And maybe a final thought to chew on. If you apply Graham's definition really strictly, thorough analysis, safety first, satisfactory return, What percentage of professional money managers today are actually investing by his standards?
Versus perhaps engaging in highly sophisticated speculation.
Something to mull over.
Okay, that was a quick, but I think really foundational deep dive. Thanks for joining us.
Hope this gives you a solid lens to look through. If we're looking at the core ideas from Benjamin Graham, the person who basically established the whole field of intelligent investing.
It's hard to overstate how big a deal he was, right?
Oh, absolutely. Before Graham, investing was, well, it was often a mess. Lots of guesswork, chasing hot tips, even superstition, honestly.
He brought the structure.
Exactly. Logic, rigor. He turned it from this, haphazard thing into a real modern profession.
And the surprising part, maybe, is that his big rules aren't really about fancy market timing or picking the next big stock.
Not at all.
Our goal here is to pull up that wisdom that shows, look, sound investing is much more about your character, your attitude, than just being, super smart.
That's the core message. Let's actually unpack his definition of an intelligent investor. Graham was really clear. This has zero to do with IQ scores or, how well you did on tests. It's, and this is his phrase, a trait more of the character than of the brain.
So patience, discipline, wanting to learn. But the big one.
Controlling your emotions, being able to think for yourself even when everyone else is, freaking out or getting overly excited.
Yeah, and history gives us some pretty stark examples of smart people failing because they couldn't manage that part.
Oh, definitely. Think about long-term capital management back in '98. LTCM?
Oh, yeah, the hedge fund with the Nobel Prize winners.
That's the one. A whole team of brilliant mathematicians, computer guys, and 2 Nobel laureates in economics. Top-tier brains.
You couldn't assemble a smarter group, probably.
You'd think. But they made this enormous bet, leveraged to the hilt, it went south, and poof, over $2 billion gone in just a few weeks.
So their genius didn't save them?
Nope. Classic overconfidence, too much leverage. Their brains didn't override their flawed strategy and risk management.
And there's an even older story, Sir Isaac Newton.
Right. Arguably one of the greatest scientific minds ever. Genius doesn't even cover it.
But he lost a huge amount of money in the South Sea bubble.
He did because, as Graham might say, he let the roar of the crowd override his own judgment. Got caught up in the mania like everyone else.
So the lesson for you, listening, is pretty clear then.
It really is. At the end of the day, how your investments actually perform is much less important than how you behave. That emotional control, that discipline, that's the bedrock.
Okay, so that behavioral piece leads us right into something Graham really hammered home. This key difference between actual investment and just speculation.
A critical distinction, and one that Wall Street, let's be honest, sometimes likes to blur. It's often profitable for them when people confuse the two.
How did Graham define the difference?
Well, investment for him meant you did thorough analysis first. You needed to be confident about the principal safety and expect an adequate return. Anything else, that's speculation.
And he had a specific warning about chasing growth, didn't he?
He did. This is a big trap. It seems so obvious, right? A company's growing like crazy. It must be a fantastic investment.
Makes intuitive sense.
But Graham's warning was sharp. Obvious prospects for physical growth in a business do not translate into obvious profits for investors.
That cuts right against how we usually think.
Totally. Because everyone wants the next big thing. He pointed to the airline industry back in the 40s and 50s. Huge excitement. Air travel was going to change the world.
Which it did. Just like the internet later on, or AI maybe now. You see the world changing and think, okay, the stocks must make money.
But the reality for airline investors, it was a disaster zone for decades. There's this incredible statistic mentioned in the source material.
Go on.
The cumulative earnings, like the total profit of the entire U.S. airline industry over its whole history up to a certain point, was negative.
Wow. Negative. They changed the world, but lost money overall for investors.
Exactly. Amazing physical growth, terrible economics for consistent investment.
And when people forget that difference between investing and, well, just betting on growth.
That's when you get what Graham might call the speculation nation. Think about the late 90s, the dot-com boom. People day trading, jumping in and out of hot stocks, ignoring diversification.
And slip in mutual funds even.
All that activity. And that high-frequency trading, that speculation, slammed you right into the transaction cost trap.
Okay, explain that trap. How does being too active hurt you beyond just making bad bets?
It's about taxes and fees. When you buy and sell quickly, holding something for less than a year, Any profit you make gets taxed as ordinary income.
Meaning at your highest tax rate. Could be 30%, 35%, whatever your top bracket is.
Right. But if you've just been patient, held it for over a year,
Then it's a long-term capital gain.
which gets taxed at a much lower rate, maybe 15 or 20% for most people. So the hyperactive trader is basically just handing over a huge chunk of potential profit to the taxman purely because they couldn't sit still.
Plus, there are the actual trading costs too, right?
Yeah.
Commissions, fees.
Absolutely. They add up fast. The source material points out that a really aggressive trader might need to make like 10% on a trade just to break even after costs and the bid-ask spread.
That's a massive hurdle before you even start making real money.
It's a huge disadvantage. So the lesson, one of the most famous in finance, comes straight from this thinking. Don't just do something, stand there.
Be patient.
For building long-term wealth, yeah. The long-term investor is really the only kind that consistently survives and thrives.
So if we're supposed to stand there, how do we resist the urge to react to all the market noise? Graham gave us tools for that, right? 2 main pillars of protection.
He did. Foundational pillars.
Yeah.
The first, and maybe the most important, is the margin of safety.
Margin of safety. I agree.
This is the absolute core of his approach. It's all about minimizing your risk by being disciplined about the price you pay. Because look, no matter how smart you are, you can't eliminate the risk of being wrong about a company or the future.
Right. Nobody's perfect.
So the margin of safety is your cushion. It reduces the chance that your inevitable errors become catastrophic losses. Fundamentally, it just means refuse to overpay. Period. Doesn't matter how exciting the story sounds.
Is there an analogy for that?
Graham used a simple one. Imagine buying a dollar bill. If you can buy it for 60 cents, that feels pretty good, right?
Yeah, definitely.
But what if you could buy that same dollar bill for 40 cents?
Even better. And safer somehow.
Exactly. Less risk because you paid less, but the potential reward is actually greater. The cheaper you buy something relative to its real value, the wider your margin of safety.
Okay, that makes sense. What's the second pillar?
The second pillar helps you use that margin of safety psychologically over time. It's his brilliant analogy of Mr. Market.
Ah, yes, Mr. Market. Everyone talks about this one.
Because it's so powerful. Imagine Mr. Market is your business partner. He shows up every single day. And every day he offers to either buy your share of the business or sell you his share.
And he's moody.
Extremely moody. Some days he's euphoric, quoting ridiculously high prices because he's so optimistic. Other days he's utterly depressed, convinced everything's going to hell, and offers you basement bargain prices just to get out.
And he's always there, pestering you to trade.
Constantly.
Yep.
Now, the problem is we humans are wired to react to those mood swings.
Especially the downswings.
Right. When Mr. Market cuts the price of something you own in half, say from $100 down to $50, what's your gut reaction?
Panic, fear, sell.
Exactly. Behavioral science shows financial loss lights up the amygdala in our brain, the fear center. We feel this primal urge to do something to stop the pain.
So how does Mr. Market help?
The genius of the analogy is realizing Mr. Market's job is only to offer you a price. That's it. Your job as the intelligent investor is to decide if his price makes sense for you based on your own analysis of the business's value.
So you don't have to trade just because he's having a meltdown or a party.
Precisely. You can happily ignore him. Or, even better, you can take advantage of him. When he's panicking and offering you great assets cheap below your calculated value with a margin of safety, you buy. When he's delirious and offering you way too much, maybe you sell.
You use his emotions to your advantage instead of letting them control you.
That's the key. And if you zoom out, think long-term, 10, 20, 30 years. Mr. Market's daily tantrums just don't matter. They become noise.
And actually, if you're still saving and investing, falling prices are good news.
Fantastic news. It means you get to buy more shares, more ownership for the same amount of money. You're getting that dollar bill for 40 cents, maybe even 30 cents. Thanks to Mr. Market's pessimism, the intelligent investor learns to welcome bear markets, not fear them.
Okay, so these are powerful concepts. But applying them? Doing deep analysis on companies to find that margin of safety? That sounds like a lot of work.
Yeah.
What about the average person?
Graham thought about that too. He knew not everyone could or wanted to be a full-time analyst, so he defined the defensive investor.
Defensive, meaning playing it safe.
Pretty much. Someone looking for decent, reliable results. Creditable, if unspectacular, was his phrase, with minimal effort and, frankly, minimal financial skill needed.
And his big insight there was
That trying to be too clever, trying to beat the market aggressively, often leads to worse results for most people than just sticking to a simple, sound plan. Don't overcomplicate it.
So what was the simple plan? Did he have rules for this defensive investor?
He did a clear checklist for building a portfolio you didn't have to constantly tinker with.
Okay, let's hear them.
Rule 1, diversify widely. He suggested a minimum of 10 different stocks, maybe up to about 30. Don't concentrate your risk.
Spread it out. Makes sense. Rule 2.
Size and financial strength. Stick to large, well-known companies that aren't loaded up with debt. They need to be conservatively financed.
Well, which is large today.
Well, modern commentary on Graham suggests thinking about companies with at least, say, a $10 billion market value as meeting that large and prominent criteria today.
Got it. Large, stable ships. What's rule 3?
Stability of earnings, shown through dividends. He required a long history continuous dividend payments for at least the last 20 years.
20 years. That shows they could keep paying owners even through recessions and crashes.
It's a strong sign of resilience and sustained profitability. And then finally, Rule 4 was about price. Never overpay.
Back to the margin of safety idea.
Exactly. He put specific limits on valuation. For example, maybe don't pay more than 15 times the company's average earnings over the past 3 years. That's the price to earnings or PE ratio. Keep it reasonable.
15 times earnings. That sounds pretty restrictive, especially today.
Oh, it is, and Graham knew it. He pointed out that this kind of strict rule would automatically exclude almost all of the popular high-flying growth stocks.
Because their prices are way higher relative to their current earnings.
Right. They're priced for perfection, for massive future growth that might or might not happen, too uncertain, too risky for the truly defensive approach.
Okay, so diversify, big stable companies, long dividend history, don't overpay. That's the checklist. But picking 10 to 30 stocks that meet all that, that still sounds like a fair bit of work and monitoring, doesn't it?
It does, and that brings us to a really important modern update, based on the spirit of Graham's work. Is researching and managing 30 individual stocks really the simplest, most defensive path today?
And the answer is probably.
Overwhelmingly no, according to most commentary interpreting Graham now. The effort involved kind of defeats the purpose of minimum effort for the defensive investor. There's a much, much easier way to achieve the same goals, maybe even better.
Okay, I think I know where you're going with this.
The index fund.
Yeah.
Specifically, a low-cost total stock market index fund.
How does that connect back to Graham, the ultimate stock picker? He seems almost counterintuitive.
But it's actually the purest expression of his defensive principles today. Think about it. Does it meet the rules?
Okay, diversification. Rule 1.
Maximum diversification. You own a tiny piece of every stock in the market. Thousands of them. Instantly diversified beyond what any individual could easily manage.
Rule 2, size and strength.
It inherently owns all the large, prominent, stable companies weighted by their size. So check.
Rule 3, dividends.
Yep, it captures all the dividends paid by all those companies. Check.
And Rule 4, the price limit.
Hmm.
How does an index fund handle that? You're buying everything, expensive and cheap.
That's where the low-cost part is key, and the discipline it enforces. By buying the whole market at rock-bottom fees and holding it, very low turnover, you essentially achieve a transactional margin of safety. You're minimizing the costs that kill returns. You're not trying to outsmart Mr. Market on individual stocks. You're just accepting his overall average price very efficiently.
And you eliminate the biggest risk Graham identified.
Your own emotions. The index fund forces you to be disciplined. You buy it, you hold it, you let the market's long-term growth work for you without trying to be clever or time things. It's Graham's simple system, perfectly adapted for today. Minimum effort, maximum discipline.
So, wrapping this up for everyone listening.
Yeah.
What's the big takeaway from this dive into Graham's world?
It's that getting outstanding investment results over your lifetime isn't really about predicting the future or having some secret knowledge. It's about effort, sure, but mostly about your intellect applied to your own behavior. It's about discipline.
And using the market's craziness to your advantage, not getting swept up in it.
Exactly. Capitalizing on the stock market folly, as Graham called it, that will inevitably happen during your investing career rather than being a part of that folly.
Okay, let's leave people with that final provocative thought, the ultimate test maybe, derived from all this.
Right. Here it is. The truly intelligent investor should be completely okay, perfectly comfortable owning their stocks or mutual funds, even if the stock market literally shut down and stopped giving daily prices for the next 10 years.
Wow, 10 years with no price quotes.
Think about it. If you've done your homework, if you trust the underlying value of what you own and you have that margin of safety, then Mr. Market's daily screaming price shouldn't matter that much. Your analysis of the value has to be stronger than your reaction to the price.
That's the real confidence the discipline brings. Trust your work, not the noise.
That's the essence of intelligent investing.
Fantastic. Thank you for joining us for the deep dive.